Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Daybreak Asia podcast. I'm Doug Krisner. The tariff story grabbed headlines in the U.S. That was as the Supreme Court heard oral arguments on the legality of those levies. Now, the justices seem to be a little skeptical, and a decision against the president could force refunds of more than $100 billion. Needless to say, it would also remove a major burden on the U.S. importers paying those tariffs. To gauge reaction in Asia, I'm joined by Mark Cranfield. He is Bloomberg MLIV Strategist joining from Singapore. Mark, thank you so much. We know that JP Morgan is already on record saying that tariff refunds would be a net positive for both small businesses and U.S. multinationals, although those companies are unlikely to pass on the benefit to end customers. And now, in the last session, as I'm sure you saw, many of America's top retail brands were able to push higher. But I'm really curious as to how this story is being viewed in the Asia Pacific.
Not too much in Asia Pacific. There's certainly interest in the potential that fentanyl might be reversed because it would affect China. But I think it's pretty much a long road. Nobody in Asia is really expecting a firm decision on that, possibly even this year. It might run into January before we see clarity on that. We have seen some short covering in American small cap stocks overnight. Not too surprising, given they were fairly underperforming against other parts of the market. From here, as far as traders are concerned, they probably are not going to hear much for the next few weeks that will really influence them in terms of that Supreme Court decision. We've heard the opening remarks. Some people have made their decisions based on that initial knee-jerk reactions. We are unlikely to get anything significant for financial markets in the next few weeks. Much more important is what happens with the shutdown.
Okay, the shutdown, I'm glad you brought that up. I mean, how is it impacting markets in the Asia Pacific, aside from what's going on in the Tokyo session where U.S. Treasuries are concerned?
Really through the channel of the U.S. dollar, especially. I think people are beginning to reassess again, thinking that if this shutdown isn't solved quickly, it is going to be a net drag on the U.S. dollar, so that would be positive for Asian currencies. See some flows back into some of the markets from that point of view. Also, the impact on the Treasury market as well. If the shutdown continues to go like this, we will be thinking that it will be a dampening effect on the U.S. economy. That will put more pressure on the Federal Reserve to lower interest rates, keep the Treasury yield curve subdued, and that will work its way through to Asian bond markets as well. So probably through those two channels is the most likely place where Asian investors are looking at this. Help
me understand, as long as we're talking about currencies, the dynamics affecting the Japanese yen right now. I'm seeing a little bit of weakness creep in at around 153.90 against the greenback. What's going on here?
Yeah, that's one of the things we discuss the most here almost on a daily basis. So much of it is to do with the fact that the Bank of Japan are really being quite timid in the way in which they address the changes in interest rates. So just yesterday, we had the minutes from the September meeting of the Bank of Japan, at which two people wanted to have an immediate interest rate hike. That was unusual for two people to vote against the rest of the board. And yet, since then, we've had the October meeting where, if anything, they were even more dovish than they were in September. So you have two sides to the equation. The Ministry of Finance have been coming in with some verbal interventions saying that the yen is starting to get a bit weak. But the Bank of Japan is not indicating any readiness to come in with interest rate hikes. Until they do, it's like one hand clapping. Traders can see it. They can see that the yen is weak, but there's not much incentive for them to go the other way because the Bank of Japan is just not behind it. In fact, people are even thinking the Bank of Japan might not even raise interest rates until next year.
So we had a pretty substantial pullback in the Japanese equity market on Tuesday. That was related to a drop in AI-related stocks here in the States. But we're not that far away from a record high in the Japanese equity market, at least if you look at the Nikkei. Can you help me understand the connection between what's going on with the yen, BOJ policy as you just laid out, and this move higher for the Japanese stock market?
Well, the relative weakness in the currency obviously helps people from the export point of view. You also got a new Prime Minister. Sane Takaichi has made it pretty clear that she intends to come up with a fairly expansionary fiscal boost to the economy. It's going to take a few weeks for her to get the full program together. But obviously that's going to be good for boosting the economic growth in Japan. So that will be reflected in the stock market as well. On the long-term basis, Japanese equities underperformed for so many years the rest of the world. So even now, it's still playing catch-up with the rest of the world. It's been a fantastic year for Japanese stocks, although Korean equities have performed even better than Japan. The AI story is still playing out in Japan to some extent, but there's other positives as well. Look at Nintendo. Just this week, they had tremendous demand for one of their games. They can't produce it quickly enough to fill orders on, and the stock opened 10% higher the following day. And that's a big company. Nintendo is one of the top 10 in the Topics Index. So there's a lot of positive stories going. And if the Bank of Japan is going to keep interest rates low and the yen's going to stay relatively weak, it's almost a no-brainer. People will look at Japan and say, well, that on a relative basis compared to other people in Asia, they have a clear advantage.
As long as we're talking about AI, NVIDIA CEO Jensen Huang was talking to the FT recently. He said that China will beat the U.S. in the AI race due to, in part, lower energy cost and looser regulations. He was basically indicating, as a part of this interview, that the West, including the UK, not just the US, is being held back by a little bit of cynicism. Now, he's talking his own book. I would imagine he wants access to the Chinese market. But how much of the success story as it relates to AI in China is tied to China being able to access those NVIDIA chips?
Certainly, it will certainly have a part to play, although they appear to be very, very quickly developing their own chips. Multiple companies in China have been announcing that they've got their own versions of these AI chips, which are either ready now or will be ready very soon. So they're coming up the curve very, very quickly. The story about the power supply and power availability in China is nothing new. It's been fairly well known, but the fact that someone like Jensen Huang brings it to global attention really should be a wake-up call for the UK and the United States, because obviously they are far behind. There's no question about it, and that gives China a significant advantage. But as you say, he also would like to sell more chips and make more money in China as well. So there's multiple assets to what he's saying there, but clearly the fact that he brings up the power issue is something that the authorities in other countries should be aware of.
Where is China in terms of being able to manufacture chips right now on the foundry side? When we think of the high-end chips that NVIDIA designs, they're produced by the foundry that TSMC has in Taiwan. Could China potentially produce sophisticated chips, whether they are digital or even analog, at scale?
What we've seen, if you take electric vehicles as an example, there was a long period when Tesla was clearly the global leader. They were far, far ahead of everybody. And just look how quickly China was able to replicate it and catch up with Tesla. You can assume something similar to that is probably going to take place in the chip space as well. If they can see it and they can identify what the need is, they seem to be able to garner all the resources very, very quickly and get the job done faster than any other major country in the world.
What about the way in which the Chinese economy is performing? We talked to Catherine Lim from Bloomberg Intelligence a couple of days ago about the Singles' Day holiday and the degree to which the government is really invested in making sure that consumers in China kind of engage and help with this problem of weak domestic demand. What do we know about the way in which China's economy has been performing if you look at some of the high-frequency data?
There have been some mixed reports on the high-frequency side, but we've just had this big gathering again where they came up with their latest 5-year plan for China, and boosting consumer demand was right at the top of the list, along with the tech sector and some other industrial-related features as well. But consumers was right up there. It was a highlight within the report. So clearly the government recognizes that they need to do a lot more from that point of view. They've also been very active. This year, there's been a big fight over the cost of deliveries. For example, food deliveries in China is a huge thing, and there's been a fight between companies trying to lower the cost here, which has been quite damaging. And China's authority just stepped in and said, okay, enough is enough. You guys need to make prices realistic and get back on an even keel here. So they are beginning to be better at understanding when they need to come in and to regulate the market on a hands-on approach and step back when they need to. But all in all, they clearly recognize that the consumers have to play a bigger part in the overall economy, and that's part of the next 5-year plan.
Mark, before I let you go, I want to get your take on what's been going on with the South Korean equity market. We had a big pullback Tuesday, not a surprise there, but it seemed as though for such a long time the Kospi has been on a tear. Help me understand what's driving the price action.
They have a tremendous retail sector there. Retail investors are as big in Korea as they probably are in the United States, possibly even more so. They have a very strong AI theme, which is benefiting from everything you hear about going on in the United States with OpenAI and NVIDIA. Exactly the same kind of things are happening in Korea because they are the partner companies to those big US giants. So people like Samsung, SK Hynix, these kind of companies are benefiting from the global demand for AI and for the deals which are being done across the curve there. Even an old school company like Hyundai signed a deal with NVIDIA a few weeks ago, and even their stock is going through the roof as well. So it's become the leveraged AI play in Asia just by being involved in Korean equities. Plus, the currency is relatively cheap as well compared to others. So from a foreign investor's point of view, you get a little bit extra kicker by going in from that. So it's been the outstanding story, probably getting a little bit overdone at this stage, and that's why you're getting the high volatility around here. But for the moment, both Japan and Korea, Taiwan to some extent, people still think they are the best way to play AI in the Asian space.
All right, Mark, we'll leave it there. It's always a pleasure. Thanks very much. Mark Cranfield, Bloomberg Markets Live strategist, on the line from Singapore here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. The U.S. equity market advanced in the Wednesday session as dip buyers stepped in following Tuesday's pullback in AI-related stocks. Semiconductor shares rallied. We had the Philadelphia Semiconductor Index up about 3%. And there was AI-related news after the bell. Snap announced a $400 million partnership with Perplexity AI. And the British chip designer ARM Holdings gave a bullish forecast for revenue given the abundant interest in chips for AI data centers. Joining me now is Robert Schein. He is the Chief Investment Officer at Blanke Schein Wealth Management. Robert is on the line from Palm Desert, California. Thank you for making time to chat with me. Can we begin by looking at this AI trade? I mentioned the pullback that occurred on Tuesday, the recovery today. How do you read the landscape right now where AI is concerned?
AI is still in the throes of growth go-go mode. Even though we've had a stall or a setback a day or so ago, if you go back even a week and you go to the hyperscalers and mega tech and you hear how they reported, you know full well that we are in the early stages of the AI growth story.
I want to focus, if I can, on Palantir Technologies. Shares gapped down about 8% on Tuesday. This company may have become the poster child for extreme valuations where AI is concerned. Palantir is trading at around 265 times estimated earnings. So, Robert, I'm curious, where do you sit in terms of the conversation around valuations, especially when a name like Palantir seems so incredibly stretched?
Absolutely. Palantir is one of those that is gotten way ahead of itself from a valuation standpoint, even though the story, is incredible. But, one of the ways you got to think about it, how do you invest in an environment like this? And it's all about stock selection. So while there's companies with the Palantir type PE, there are other companies that still have tremendous room to run. Not to that extent, because we believe that's ahead of itself. But there are a lot of AI stories that are still undervalued.
So where are you looking for value? If we can talk about the broad AI picture, there are obviously names like Palantir, which we just pointed out is pretty rich in terms of valuation. There's the NVIDIA story, and then if you get into the hyperscalers, it's obviously a story about Alphabet, Amazon, to a lesser extent, maybe Microsoft. But I'm curious about how you discover value if you want to stay committed to this thesis.
We're still committed to the mega tech at the early stages right now, simply because the operational efficiency mindset, which has really become very infectious. Again, you see companies like Amazon investing like they are, getting the growth in the cloud, like we're seeing it play out, but yet they're also laying off 30,000 employees where they're still focused on the bottom line. And it's a testament that they could do more with less. So the mega tech is still where we're seeing this, simply because the AI offsets in productivity growth. Even Goldman Sachs said that it's a 1.5% accretive to output, year over year across the baseline. There are 4 stages, as we're seeing, of AI: the traditional AI, generative AI, and then the pre-AGI, and then. But we're still in the first couple of stages right now for stage 1, stage 2. And so mega tech is really leading the way. And that's where I would stay, simply because of the free cash flow and the fortress-like balance sheets.
Can you give me a sense on how much above your cost basis right now you are in some of these big names?
Tremendous. I mean, we've been in the Apples, Amazons, Microsofts for decades. And so that seems to be the issue across Wall Street. Not only is the contribution relative to the cap weighting or the S&P index, how much they've grown, how much they contribute, but yet a lot of Wall Street's locked into low cost basis on all of our taxable accounts. So we do trim, like we did trim NVIDIA. We do trim some of the larger cap mega tech and reinvest that and diversify that into balanced. And I will tell you, that's not the phone call you want to get from a client that sees you sell NVIDIA and just a little bit, you take your cost basis off the table and you hit a tax gain. And then they see that you invested in something like Warren Buffett and Berkshire, which is slow and steady. And over time it will win out. But it's not in the fast lane like tech.
So you mentioned Buffett. His cash position right now is at a record high, and I'm curious about the level of cash you have on hand right now.
Yeah, we're sitting about an 8 to 10% cash position across the board. And cash, I mean cash equivalents, it's still getting well over 4% for our clients. But we, again, step into volatility. We did that earlier in the year in April. And when the markets basically came to us, we saw a lot of opportunities. Much like Warren Buffett is moving forward, we keep dry powder on the balance sheets for just, whether it's a headline, a tweet, or some geopolitical event that provides an opportunity. We still believe in the growth of the market and the growth of the bull market as well moving forward.
So if there's a pullback in some of these AI names, are you a buyer, or do you want to be diversified away from some of the big gains that we have seen right now in the big cap tech space that you just laid out?
If an investor has no exposure, you jump on some of the pullbacks. If you're overexposed, overweighted in your portfolio, it's okay to start trimming into the strength. You're not going to go broke taking a gain. And over time, you could reallocate that to, again, the value play, which balances your portfolio and keeps that ballast in the portfolio when there is volatility, and gives you an opportunity. And also keep cash on the sidelines so that you're not 100% invested, so you can jump on these opportunities. Let's
talk a little bit about the macro picture vis-a-vis the Fed. I mean, if you look at the Atlanta GDP Now forecast, I think the growth that they are suggesting in compiling data is around 4%. It's unclear as to whether or not we get a rate cut in December. I think the probability right now in money markets is around 70%. Today's economic news was pretty upbeat. I mean, U.S. services activity expanding at the fastest pace in 8 months. You look at the numbers from the private payroll services provider ADP. We had job growth in the private sector jumping by 42,000. So it's not clear that the Fed is going to continue to be accommodative, at least in the short term. Or am I wrong on that?
You're 100% right. And that's why we saw the market pull back when Jerome Powell basically took the Fed put off the table of a built-in, baked-in December rate cut. And so markets are pulling ahead gains from 2026 into 2025. We still believe that's going to be the case in terms of front-running the Fed and believing that there are more rates to come. But our biggest concern moving forward is just that, the Fed. We saw that we do need the Federal Reserve to bring down interest rates to help housing, which would unlock a good percentage of the overall economy that has been frozen and stalled for so many years. But what if that doesn't happen? We're also going to get a potential reacceleration in the GDP in the new year, simply because the one big beautiful bill, the free cash flow boost to the S&P 500 companies right away, as well as to the consumer. January 1, there's a tax reduction that goes into effect in payroll taxes to the equivalent of $150 billion for next year. So that extra money, liquidity, is going to go in the system. That could go against what the Fed is ultimately trying to do, which is, put the brakes on inflation. Inflation right now is at a low-grade fever. And so, and even tariffs is that one-time inflation a bump. And oil's working in its favor right now. But again, it's shelter, and it comes down to the Fed and rates.
So where does the Fed leave you when you look at the financials and you're talking about rates? The expectation here is that we do, maybe not in December, but in the first part of next year, we do maybe get another cut. Where are you with the financials in that scenario?
Financials is a quality sector. Again, solid balance sheets on the large and mega cap names in that space. And as we know historically, when rates come down, a lot of that flows to by way of IPOs and liquidity, and just a great space to be in. And financials will do well as it relates to a lower interest rate environment moving forward.
So it's not necessarily a story about more lending. It's a story about maybe trading revenue. Maybe it's a story about merger and acquisition activity if you're looking at the big banks.
It'll unlock merger and acquisition activity and IPOs again, and again, unlock that Wall Street spirit.
Robert, we'll leave it there. Thank you so very much. Robert Schein is the Chief Investment Officer at Blanke Schein Wealth Management. He's on the line from Palm Desert, California, here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.